Hi everyone, and welcome back to this wealthy education video on how to use exponential moving averages. The exponential moving average, as we talked about at the end of our last video, can give us a support and resistance level to trade stocks that are moving up in an uptrend or trending down. So let's talk about the exponential moving average. A simple moving average is calculated by adding together prices in a given time frame and dividing by the number of time frames. So a 20-day simple moving average would take the closing price for the last 20 days, add them all together, and then divide by 20. The EMA, or the exponential moving average, is calculated in the same way, except the closer in time frames, so the closer days are given more weight than further out days. So yesterday's closing price would be given more weight than the day before, which would be given more weight than the day before. We can use EMAs in a couple of different ways. We can use an EMA as a support or resistance indicator, or we can use two EMAs with different time frames to get an indicator that will give us a buy and sell signal. And I'll show that to you on a chart in just a moment, but we'll have a fast line, which will be represented by the lower number of time frames, and we'll have a slow line, which will be represented by a higher number of time frames. So for example, we could have a 20-day line, which would be our fast line, and a 50-day line, which would be our slow line. You'll hear of two particular types of moves with an EMA. One is called the golden cross, and the other is called the death cross. The golden cross is when the 50-day exponential moving average crosses above the 200-day exponential moving average. And the death cross is the opposite. It's when the 50-day EMA crosses down below the 200-day EMA. And these are two types of crosses that are paid particular attention to with the S&P 500 or the Dow Jones Industrial Average. But they can also come into play in individual stocks. So let's look at the EMA on a stock chart. Let's use a chart of Wells Fargo to demonstrate how we will use the exponential moving average. So we type in WFC in the upper left, and that gives us Wells Fargo. We move over to indicators, type in EMA. It comes up as moving average exponential. We're going to click that, go to format, and we're first going to look at the 50-day exponential moving average. So we hit OK, and this brings up the 50-day exponential moving average. With the exponential moving average, we want to be short or not long the stock when it's trading under the exponential moving average, and we want to be long the stock when it's trading above the EMA. So if we start at the beginning of the chart, we see the stock is below the 50-day exponential moving average, and it's in a downtrend. I'll add a downtrend line here. And it's below the EMA. So we'll use the EMA as our support and resistance level. When the stock moves above the EMA, as it does here, we would get long the stock. The stock moves from 54 to around the 56 level, comes back and closes below the EMA, moves back again, positive through the EMA, and then comes back through the 50-day EMA again to the downside. So we may have taken a couple of trades here that were losing trades, or we did not make very much money on these trades. And then the stock moves above the EMA again here in June. Closes above the EMA in July, so we're still above and we're still long the stock. And we get a move from around the 55 level up to around 59 before the stock gives us a sell signal here in September, and then Wells Fargo moves to the downside. So we can see in the uptrend, the stock is generally above the EMA, and then as the stock crosses to the downside, we get a downtrend in the stock. So that's how we would use a single EMA to give us a signal as to whether the stock is moving up or down. Now, let's change our EMA. We're going to go to Format again, and we're going to use a 10-day EMA, which is going to be our fast line. We're going to add another EMA. So go back to Indicators, type in EMA again, click on Moving Average Exponential, and for our second EMA, which is going to be blue, we're going to make that a 20-day EMA. Here we see the 10-day crossing the 20-day and giving us our buy and sell signals. Here, where we marked it earlier, we have the 10-day moving above the 20-day after the stock had been in a downtrend. It stays above the 20-day until June. We get a cross to the downside, and then another cross to the upside as the stock is in an uptrend here. So by using two different EMAs, we get a little clearer signal as opposed to just using the single EMA by itself. And as we can see here, the 10-day crossing the 20-day to the downside would have given us a signal that the stock was moving into a downtrend, or that we would not want to be long the stock. If you want to generate more trade signals with your EMA, you can use a shorter time frame. So in this case, we're using a 10-day and a 20-day, but you can use a 5-day and a 10-day, and you would get more buy and sell signals. And if you want fewer buy and sell signals because you're trading on a longer time frame and you don't want to move in and out of the stock as regularly, then you would use a larger time frame. So you could use a 20-day and a 40-day, and it would give you fewer buy and sell signals in the stock. So that's how we use the single EMA as well as the combined two time frame EMA in the stock of Wells Fargo. Thanks for watching this video on the exponential moving average. In our next video, we're going to talk about the moving average convergence divergence indicator, which is a particular kind of exponential moving average, and how we can use the MACD to improve our trading. Thanks for watching this video, and I look forward to seeing you in the next video.